Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I just wanted to start by saying we'd like to wish everybody a happy Thanksgiving. And this is going to be our weekly market update on what's going on in the Phoenix housing market and kind of what's impacting the market in general right now. Just some things to be aware of. I am going to share my screen with you here, so let's go ahead and jump right into that right now. Okay, so what we're looking at right now is our here's just a couple of articles I wanted to share with you on what the Fed's talking about and what's going on with the economy in general, and then how this affects our business in real estate. So wholesale prices rose 0.2% in October, less than expected as inflation eases. They were expecting about double that, so that's a good sign. Walmart actually came right out and told their suppliers, and this is based off the producer price index. The producer price index is basically that index that shows, the prices that wholesalers are getting their products in for. And basically, Walmart came right out and said to their wholesalers, look, and their suppliers, we're just not going to take this incredibly high marked up inflationary type products any longer. You're going to have to lower the prices. So a lot of this is having that's part of what's having an impact, along with the fact that people just aren't spending the money on a lot of this stuff anymore, and people are really kind of, even during the holidays, they're really tailoring their spending a little bit more than maybe they usually do. And since we're heading into the holidays too, we're also, since the Fed is doing what's called demand destruction, or trying to tame inflation by raising the Fed's fund rate, which affects what it costs to borrow money, basically, on core items and things like that. What we're seeing is their doom and gloom tale, and that is going into holidays makes a lot of sense in a lot of ways, and we're already seeing a trend down in all these data points. So it's encouraging. It's great. We'll get into that more in a second, but that was the first thing I wanted to share with you. And then if we look at mortgage applications increasing, that's always a good sign. And basically, in a nutshell, when I've mentioned this many, many times and kind of summarize this, inflation goes up, interest rates go up to tame the inflation. And then once we hit a recession, start heading into a recession or a bad economy, what happens? Well, that means inflation is then being tamed, which means that interest rates start to drop. Okay, and usually what we see is, except for the housing crash, which caused that particular recession, we see that housing is typically the Robin Hood, or the winner, the hero of the economy and the markets. So, we're going to see that again here. We're going to see a huge rally coming. I'm not saying it's going to be another anomaly year, but I think we're going to have a very, very strong year coming up in the housing market. And every indicator, again, there's always the things that can come out of left field. I can only give you what's likely. I can only give you what, I'm not an economist. You want to check with an economist, your attorney, your CPAs, your financial planners, all those sorts of things. I am not an economist, but I can only share with you what the data is saying, what's likely, what's happened over the past, 20, 35 years, 40 years. And that's those are the data sets, data points, kind of what drives the market typically. And these are the factors. So we look at mortgage applications increasing for the first time in 8 weeks. And it makes sense because over the last 2 weeks, interest rates overall have come down a couple of times in a big way. There's always that little fluctuation in there. Things change by the hour and the day. But overall, basically, if you're looking at a government loan this week, and again, I'm not a loan officer, things can change by the moment. We've got some great wholesale lenders you can talk with, but what to keep in mind is that things are trending down, and government loans right now, you're probably going to see a 5 in front of those, and that's without buying down any rates. That's with good to moderately good credit, not spectacular credit on conventional and other type loans. we're probably going to see, you're probably going to see a 6 in front of it, but it's going to be a low 6, okay, low to mid 6. Whereas just 3 weeks ago, we were in the 7s on average, or the 6s, depending on the type of loan we're dealing with, the high 6s. So huge fluctuation, huge savings for people. And so whether you're a seller or a buyer or thinking about selling or buying, you're maybe coming out of the hibernation stage or thinking about coming out of the hibernation stage. And this time of year, unless you're a seasonal traveler, or you live in 2 different places throughout the year seasonally, which we have a lot of that here in the Phoenix area, like a lot of markets. You're looking at these things and you're like, I may or may not sell it, whether you're an investor or just a regular homeowner and seller and buyer. All those things come into play here, and everybody's situation is different. But when we see that these mortgage applications are increasing, this is a very strong indicator that things are good, where rates have come down, and the whole type of situation that we're in with taming inflation is working. Everything that's all trending down along with the rates. Now, we also know that even though the Fed is usually, a lot of these guys, live out of workbooks, they've got the degrees and stuff, probably never ran a company or even a lemonade stand in their entire life, and not really understanding how business really works. But we see that they understand that, we're going to have another rate hike here over the next month or two, but it's not going to be quite as much as some of the other rate hikes that took place, just to make sure that we're out of the woods, so to speak. We'll see another report coming out in December, which will show, like the last one, that the rate of inflation is lower than it was last year. Okay. And same thing in January, but those numbers, that report won't come out till February. Remember, it's always lagging 1 month. So the good news is that we're on the downward trend and out of this cycle of nightmare, and the Fed basically having to play some catch up here with us, right? So that said, let's pop right into another little segment that I had for you guys. Let's see if we can get this up. Okay, sorry about that. I had to pop over to a different screen. Okay, all right. So, all right, guys. Hopefully you can see that. Looks like we're sharing again. All right. So I've gone over this before. I just want to run through it really quick and also give you a couple other little tidbits in here, and make this as simple as possible. Right now, people are worried about going into recession. There are a lot of layoffs. I mean, just to name a few, on the job sector, there's a lot of layoffs happening. But again, we're going to see that the housing market is going to be the Robin Hood here. So we see that we've got Twitter down 50%. We all know the story there, what's going on. Keep an eye on that. But Facebook, 11,000 jobs chopped, which is about 13% of their workforce. Snapchat dropped to 20% of their workforce. Shopify 10%. Netflix 450 employees. Microsoft 1,000. Salesforce 1,000. Robinhood 31% of their workforce gone. Amazon has a hiring freeze, and you see that Apple has paused hiring, and Google is reducing the amount of hiring that they're doing. So, again, when we're in a bad economy, though, rates will start dropping and we'll see buyers coming back to the market. Will we see some foreclosures? We may see some foreclosures, but based off of, like we just saw recently, 150% increase in foreclosures. Okay. But when you come from absolute zero from last year, when foreclosures were not allowed, it's really not that much. I mean, for instance, when we look at these percentages, it may mean going from 8 to 30 on an MLS, and it seems like, oh, it went up, whatever, 200, 300%, but it's really not the end of the world, like a 2008. And we just don't have the amount of inventory that we had. Like in the Phoenix area, we had 15,000 homes on the market during the crash. Right now, give or take, we've got about, 18, 19, 20,000 homes on the market. The last 2 weeks, I'm going to show you, I'm going to talk about it more in a minute. Last couple of weeks, we're way down on our numbers for new homes coming on the market. Again, some of that seasonal, some of that has to do with the interest rates. A lot of the FOMO sellers, the iBuyers that way overbought, which by the way, OfferPad may be losing their status as being traded on the stock exchange because they're under $1 a share. Redfin's no longer doing iBuying, Zillow's no longer doing iBuying, which these companies are basically were like wholesalers when it came to iBuying, basically like a wholesale type of deal. But suffice to say, those sorts of fads, those sorts of overbuying, over purchasing, and then having to reduce those prices so low, it brings a lot of fluctuation to our MLS and our numbers too when we see price reductions. I mean, they're really reducing their prices, and it's a pretty good share of the market. And we see a lot of investors who wanted to jump ship out of the market too once rates started going up, and that inventory kind of doubled or tripled, but it's kind of holding steady right at that mark of, for our MLS anyway, right around that 20, hovering around that, let's say 19 to $20,000. I'm sorry, 19 to 20,000 total inventory mark. But keep in mind also, as well as the iBuyers and stuff sitting a little bit longer just because of the time of year and higher interest rates, people in hibernation. We also have a lot of builders who were starting to catch up, but they still couldn't keep up with the demand. They're still not keeping up. And really, that's really, really, really the new inventory are the builders. And they weren't listing a lot of the stuff online or on the MLS either, because they didn't have to, because the homes were selling so fast up until like April, May or so. And our market and most markets where, rates went up, inflation was already up, prices were already up, but rates started going up. And once we got, above that 5 and 6% mark on rates, up to 7 even here recently, people stopped with the buying, and things really slowed down. So anyway, that's where we're at here. So when it comes to inflation drives mortgage rates. I just want to show you this again real quick, and then go into a couple other key points for the market update here that we're doing. During that QE period, it's listed there on a chart. We saw that basically the Feds fixed the rates at about 3%, buying mortgage-backed securities in huge numbers. And then when they stop, we see where, the numbers started going up along with the inflationary factors, and we got into the trouble we're in now, and basically the Fed was way behind the 8 ball. So let's see if we can get this working. There we go. So what is inflation? Too many dollars chasing too few goods. So the Fed raises the interest rates, the Fed's fund rate, what it costs to borrow money. This indirectly affects mortgages, but in the end it does. Fed hikes more on the banks to lend the money. And then we see that, people are forced to stop spending and save their money. And this is what we say is taming inflation or demand destruction, keeping you from going out and buying that new car. You're thinking twice about, buying that home right now, maybe waiting or whatever the case may be. But I'm going to tell you right now is a phenomenal opportunity, because right around the corner is that lower interest rate, and it's actually here now, and I'll explain how. So the CPI, is that core inflationary rates that we're looking at. The drop we told you was coming is coming, and we saw the drop in the October numbers on November 10th. We went over this in another video. We saw, month over month, year over year, all the different factors are down. The headline number, the core number, what the Fed feels like they can control, from 6.6 to 6.3%. And the shelter costs, though, seem to be really high, right? Seem to be really high. And then you've got this, this OER, okay, which is basically, what people are paying for their rents. And it's not an exact science. There's a lot of poor reporting on this. In a nutshell, to kind of drill down on this, on what people are paying for rent. in the end, a lot of this has to do with surveys. People will call and say, how much do you think your house will, so how much do you think your house will rent for? Now, I kind of have a general idea, but I haven't not even drilled down the numbers on my own house, and I do this for a living. So, a lot of people just don't know what their home is going to rent for. So it's kind of crazy how they kind of figure some of this stuff. But what a lot of people missed was crazy lodging away from home, okay, for October was up 4.9%. What is that? We've got hotels, Airbnb, all these sorts of things. So lodging away from home, we see these fluctuations. And again, a lot of this is just really, really bad reporting. Okay. But in the end, we're going to see that the inflation peaks. What we're really looking at is what we saw this past report, right? And this is why we know what's coming. This is why we know what's coming. Okay. And we look at these numbers and we want to look at what's it being replaced with year over year, month over month, but year over year is the real indicator. Because look, right here, we were at 0.3, like we just showed you in the previous chart. But where were we last October? We were at 0.6. Okay. So the core consumer price index, okay, is, again, we're compounding and rounding how they figure these numbers out, and they look at what people are buying, and they look at what they can control, meaning the Fed, in lowering the inflation rate. Okay. They can't control food, they can't control energy, because they look at it as, well, I don't control the weather and the crops from the weather, and how those are going to turn out. I can't control oil embargoes, and those sorts of things, or pipeline bursts, how many leases the government's going to put out for, drilling and all those sorts of things. But the things they can control, how much it costs to go buy a car on credit, which 16 out of $17 is basically bought. Everything's bought on credit. Okay. So when we look at this year over year, 0.6 inflation going up. Now we're looking at 0.3 last month. That means that inflation is coming down. The upcoming Fed meeting in December will tell us basically the same tale. And we see with shelter costs, again, they're always lagging, and they usually take an average of this, and they do their surveys and phone calls. It's kind of crazy how it's, but what is it? They take an average of this. It's not an exact science, but we see that it's coming down, right? That's slowing also. Okay. And shelter is 39% of the core CPI, but we see that this is coming down year over year national average. And what does that look like? Well, it looks like a roller coaster. And again, I admit I am taking all this information from the best of the best, and that is Barry Habib with MBS Highway. And when you see that always the Fed is always looking in the rearview mirror, they're always behind the 8 ball. They were behind, stagflation, and we peaked back in the spring or summer, whatever they had to say. And none of that was the case. All that was nonsense. And we kept saying so at the time. So now we see that, the shelter in CPI way back here, we're going to be at our peak of inflation and shelter costs and everything that we're looking at here as far as inflation goes. Pretty much right now, everything's trending down anyway, but by January, it's going to be peaked out. So the real shelter cost is beyond that. We're already here, but this is all lagging. Okay. So in January, they don't meet. February, they do meet. They have the Feds have their next announcement that'll be about what was going on, for January and December, basically, because it always lags a month. And that'll give us the real picture. Now, also two other things. The first is the money supply. Okay, so we're going to see that by March, believe it or not, the money supply will be declining, and we're going to see money supply declining over the past 5 months. first time since 2004. All right. And we saw this huge increase, 40% increase from that, Fed stimulus and all the COVID stuff and the, Inflation Reduction Act that was actually Inflation Production Act. I mean, anytime you're printing money, too many dollars, chasing too few goods, you're creating inflation. Even when you go buy a car, it's an inflationary factor when that money comes out of nowhere to give you that credit. That's an inflation. Money comes out of nowhere, it's an inflationary factor. So all that's being tamed, demand destroyed. Now we're coming into this declining money supply. So less money, more goods. Okay. What happens when you have more goods? Things goes on sale. And then we see another little factor here that is very interesting. 30-year. Now this is going all the way back, looking all the way back to 1991, 35-year history. And we see 30-year mortgage rates versus 10-year treasury spreads. Now, usually they're always 175 to 200 basis points spread. Right now, we're at about a 300 spread, okay? So we can see the normal spreads, and then we saw where we were coming into the pandemic and where we are now. This is also a huge indicator that we're going to see this these interest rates come down, okay? Again, all what is likely, anything can come out of left field. I'm not an economist, but what is likely over time, what normally should happen, and this is what we can expect to take place next. Always be looking ahead. Don't be like the Fed looking in the rearview mirror. Okay. Now it's a perfect opportunity in housing. Okay. Because right now you still can get great deals. The best time to buy a home, typically in a lot of markets, and I could say, even here, the only exception to that might be in some of the retirement communities, but our slow time of the year is always around the holidays. Okay, always a little bit less inventory, and any buyer that's out there looking at properties is a very serious buyer. So it's a great time to get some deals because people, they want to get rid of these properties, these high buying companies, that were out there like OfferPad and Redfin and, Open Door and all these companies. They want to unload these properties they paid way too much for. So that's a whole nother addition to the normal end of the year. People want to unload stuff. They want to unload stuff, to get through the holidays, get into the next year, start with new investments into the next year, deal with their taxes and all those sorts of things. Okay. All kinds of factors on why we want to sell at the end of the year. But the perfect opportunity in housing, because you can get a great deal right now with a rate so high, homes have been sitting longer than usual. Okay. So you can get a great deal on that. Then you can get closing costs. About almost half of our people are seeing that they're getting closing costs. So, this is just an example of, $500,000 purchase last year. People were getting $50,000 over asking price, no terms, no inspection, no, not to worry about, people were waiving appraisals, all kinds of crazy stuff. So now, we got normal negotiations of just 2% on $500,000 purchase price, may equal like $10,000. So you can take those closing costs you're getting, okay, which is actually more important in the end than your payment and what you're going to be paying in interest rates, especially in the beginning, with a permanent buy down, okay, where you can decrease your rate by 1%, or you can do a temporary 2-1 buy down, where basically you can take those closing costs, and the first year you're paying basically what you were paying last year in rates almost. Okay. And then the second year goes up a little bit more, and the second year or third year goes up a little bit more from that. But next year, on this example of $400,000, 7% note rate, where we're doing a 5% year one, okay, and that's very conservative on what's being quoted on a lot of 2-1 buy downs. This is the difference from 7% to 5%. It's $26.61 to $21.46. You're saving over $500 a month with a 2-1 buy down initial cost you're getting the closing cost from the seller of that over $9,000 or 2.5 points being paid down. Okay. But next year in 2023, when we see these year-over-year inflationary numbers coming down and then rates coming down, you can refinance that 5% or even lower into the 4s when rates come down and receive a credit. Okay, you can take that money out of the escrow and use that credit to buy down the rate even more. So it's a phenomenal opportunity to get the best prices right now, still get an amazing rate. I mean, even if you didn't do it, you just refinance next year, that's great. And even if you didn't, wages are going up. Okay, I talked about that in another video. Okay, but here's just a quick example of kind of how it all runs in and how the breaks come in. And the first year, how you're so much further ahead, first going into the second year, and even into the third year, how you're still ahead versus just a strict new loan and what that would look like. So an amazing opportunity. Right now, median sales price, according to Redfin, are still up, believe it or not. This is country across the country, up year over year 3%. Okay. Yes, over here they were in the anomaly, up even more, but that anomaly, we're not going to be going up 20% every year, guys. It's just we got to act like adults here, right? We're not going to hit the Super Bowl every year. So 3% is still amazing across the country. Okay, it's about the norm. And we can look at, when we look at these other lines here, 2019, 2020, we're still way above. We're still way above where we were then. So guys, when we look at these overall averages and stuff and the anomaly year and everything, it has to be brought into perspective of what that really means. Okay, in reality. Okay. Chris, people are getting laid off. Yeah. Okay. They are. But again, context. Okay. During these, boom years for a lot of people and these super hyperinflated years, they had to hire more people. When you own a company and you hire more people when things are doing well, okay, you hire more people when things are doing well and you're busy, okay, but then you lay off. Maybe you had to hire an additional 1,000, but now you're laying off 500. So you're still ahead that extra 500, but you're laying off 5. So it's all within the context of where you're at on that. And this also falls into these inflationary and interest rate factors. The wires just go. I heard Grant Cardone the other day. Why? I can't believe. Why are these people getting laid off? And it's horrible when people get laid off. Don't get me wrong. Nobody wants to see anybody lose a job, but it's got to be brought into context, and it's got to be brought into the idea that we're doing this, this quantitative easing or lowering of inflation, a lowering of interest rates, and a recession. For the basically means the housing market's going to rally. It does every time. Again, one recession due to the housing market, due to overbuilding and poor lending practices, due to the overbuilding. So let's just make up poor lending practices. And we're not in that case. We're not in that case, guys. We're not in that case. All the doom and gloomers, there's a couple of them, they're not even on YouTube anymore. Okay. The Diane Olics of the world, they've been wrong every time. They're always wrong on MSNBC or whatever the heck network she's on. So, guys, it's all got to be within the context of what the reality is. And I also wanted to go into the local market. Right now, our CMI, which is the Crawford Market Index, puts us at 88.6 overall. So if we are below 90 on the index, we're in a buyer's market. If we're over 110, we're in a seller's market. And right in the middle, right at 100, that is a balanced market, or within that range of 90 to 110, right? 100 being dead center, true north. So we're at 88.6 overall. That puts us no surprise there with the rates the way they've been in a buyer's market. That's why it's telling you, this index is telling you we're in a buyer's market. You can get great deals right now. You can still do those 2-1 buy downs. You can get those closing costs to pay for your title escrow fees, and these 2-1 buy downs or buy down the rate, and rates just in and of themselves without doing anything have dropped over the past 2 weeks a couple times. There's been a little fluctuation in there, but overall they've dropped. So guys, like I mentioned before, so it's a great time. It's a great time to buy. I mean, like if you were looking at this just a couple weeks ago, just to throw out a random round example of $250,000, I mean, you'd be saving about $150 a month right now, not doing anything, just going with the rate that you'd be getting on the box. Okay, using round numbers. All right. Supply index on the Crawford Market Index is at 82.5, 82.5. Again, below 90 is a buyer's market. And I remember when that number was down to 20 back about 9 months ago. Okay. The demand is at 73.1, 73.1 for our demand. And again, we're so that being below balance by about 27 points on the demand. And again, people are in hibernation. It's the timing. Every year it goes like this: holidays down, holidays down, holidays down. Okay, we get through spring and summer. Okay, get through spring and summer. Okay, every year, every year, every year. So the anomaly year was insane, but every year for going back 35, 40 years, guys, we're seeing the same thing over and over again. And one guy, inventory straight up. And it's true that we're not getting I'm going to get into that in a second. We're not getting the inventory coming out of the market that we'd like to see in the Phoenix area, but overall everywhere in inventory is down. It's not over. We don't have over inventory here locally or across the country in general. So the idea that we're going to be in a crash would mean that we would be oversupplied, and we're not oversupplied, guys. So this is actually a good thing when we start coming out of this. Now that's going to create more demand. So again, that's another reason maybe to buy now, to not have to compete with everybody else later on when rates go up. Just throwing that out if you can afford to, right? So every single city in the Phoenix metropolitan area has gone down on the Crawford Market Index. Fountain Hills, Scottsdale, Cave Creek, those are all still sellers market technically. Paradise Valley, Phoenix proper, Chandler, Glendale, let's see. I'm sorry. Paradise Valley is in a balanced market, 99.3, so it's actually just below a balanced market. But Phoenix and everything else, basically in the whole valley, Buckeye coming in last, those are all, meaning on the index, all buyers markets across the board. So Buckeye is a super buyers market right now, so at 47.6. Okay, and Fountain Hills topping it the list at 149. Going on to the next part of this data, a CMI change over the last month was negative 9.8 versus last week of 10.8. So again, going into the holidays, rates fluctuate a little bit, not surprising at all. And then if we look at new listings coming on the market, the first 2 weeks of this month, we've only had 2991 in new supply, 2,991 homes come on the market. Now, going all the way back to 2005, that's rate less than half of that. Last year we were at a little over 4,500. In 2020 we're at 4,253. 2019 we're at 4,043. I think what this tells us, guys, is with the higher interest rates that we've had in a very long time, and with the time of year that we're in and the way prices have risen, I think we're going to see people are just kind of in hibernation mode, and they're waiting for maybe a little bit more inventory and choices to come on the market and the rates to come down a little bit more. They don't know about 2-1 buy downs and all these things. That's why I keep talking about it. because you can get into the game now, get the deal now if there's something out there you like, and move on to that next thing. But then there's a matter of if you need to sell your house. Things are moving a little bit slower right now, but we certainly have ways to and solutions to get around that too. But there's no doubt about it, things are moving slower. And when we break it down even more, condos and townhomes are down as far as the amount of inventory coming on the market. The amount of inventory coming on the market is down 38% when it comes to condos and townhomes. When we see single family homes, it's down 33%. Let's see, if we look at each city individually, or just a few of them here, Phoenix down 43%, Tempe 37%, Scottsdale 35%, Gilbert 41%, Chandler 47%, Mesa 24%, Peoria 47%, Glendale 31%, and Surprise 21%. So we see across the board, we definitely got an inventory shortage, and just the amount of household formations that we have. I've talked about this in other videos across the country and in Phoenix area. We just don't have enough building going on because builders got smart after that 2008 crash, and they didn't want to overbuild like they did before and then have to try to unload it with all this extra inventory, and that would create some issues. So they're not doing that anymore. And that's where we are, guys. If you have any other questions, I'll be putting out some other videos later this week and next week, of course, and I'll be getting you some other information and some details on what's going on in the market and some other little tips and tricks. But guys, if you have any other questions, let me know. I'd love to be able to help you out, and we'll see you next time. And again, have a happy and safe Thanksgiving, guys. Enjoy with your time. Thanks. Bye-bye.